Hello and good afternoon. I welcome you to today's special webinar here on FX Street, exclusively for JFD brokers, how to trade the market opening of the US markets. My name is Jens Klatt, and I'm...
Hello and good afternoon. I welcome you to today's
One
special webinar here on
second.
FX Street, exclusively for
Yeah, so, and I will just guide you through the upcoming 60 minutes, yeah, in fact, around the market opening of the US markets. By the way, I stopped, I think, where I said I'm Jens Klatt. Yeah, I'm the global head of research and education here at JFD Brokers, and that's nearly all I have to say about myself. And yeah, so as usual, I want to present to you a setup which is in fact a very, very easy one. To some, it might really look very trivial. Nevertheless, how trivial a setup might look at in the end, it counts whether it makes money or not, whether it's a robust system, it's a stable system. And in fact, it's a very, very stable system, one which is profitable for years, over years. It's really fascinating. It has been not really invented, but it was at least introduced to traders, I think, during the 1980s, if I'm not mistaken. That was in a series of articles a guy called Toby Crable wrote for a magazine around trading. And the approach is called the open range breakout approach, so ORB here. And I've adapted it a little on the Dow Jones and S&P, even though I'm also trading this approach here, where I could also give you an approach here, for example, for the DAX, a proven profitable approach. There we have to obviously change the parameters here in one, because the DAX, this is the German equity index here, has another opening range because we already started trading there 7 hours ago. 7 hours ago, yes. And there, for example, the range is 6 a.m. till 7:05 a.m. GMT. For example, and it's not the exponential moving average 10 as here in the Dow Jones, respectively the S&P. In fact, it's not on the Dow Jones, but it's the S&P. It's not the exponential moving average 10 on a 50-minute time frame, but in case of the DAX, we're talking about the exponential moving average 50 on a 5-minute time frame. But all in all, the setup itself is based on this range, however you define this, and based on an identified advantage. So meaning nothing more, we're trading above that, we trade the break out of the range on the upside. We trade below that, we trade the break out of the range on the downside, and only that. If we're trading, for example, above the exponential moving average 10, but breaking out on the downside of the range, we're not trading. And the same is true the other way around, meaning we're trading below the open range, below the exponential moving average 10, for example, on a 50-minute time frame, breaking out on the upside, we're not trading, since the overall identified advantage should be seen on the short side. So, yeah, what I want to do in the following now is, first of all, give you an idea of where we currently stand in the markets. The price action so far has been positive, which is surprising. And in fact, it was in the morning already that during the morning meeting here I held for JFD Brokers, that I said that some probably see some strength out of the current price action we see here in the markets. And this has to do with the fact that there are plenty of reasons for the markets to really sell off sharply. And that really, in fact, started where is something which should be mentioned here is with the trade war fears around China and the US. There has been comments from Xi Jinping. Let us now go over to the markets here. So now you can see the DAX pushing higher. But here, let's first start here with trade war fears, for example, overnight here from Monday then to Tuesday, or in the night of Tuesday here in Germany in this case. When we woke up, the DAX traded significantly higher compared to the close we've seen here on Monday, nearly 150 points. And this very brutal gap, let's say, in fact, it wasn't it was a true gap. Nevertheless, it was closed quite quickly. So we started good into the trading week, only to sell off then, and then open nevertheless sharply higher. And the reason was that Xi Jinping was talking about an opening of China to the outer world. So was mentioning that China is very interested in doing business, for example, and opening the doors here, for example, for automobiles and all this. This is in fact really interesting because currently the market, that was in fact what was suggested here, that he was somehow addressing the US here and trying to avoid that the overall situation here between Washington and Beijing escalates. In fact, he never mentioned the U.S. He never mentioned a nation in general during his speech here on Tuesday morning, but he was only referring to sectors. In this case, automobiles, insurances, or finance, and that was really interesting because market participants who read this, and I mean, if we look at the price action, obviously, market participants heard something positive out of what Xi Jinping just said there. Nevertheless, the thing is that it could also be that his words and his speech in general indicate that there will be an escalation and that he says, yes, we are open for business from other countries and their products like automobiles, finance, insurances, and all this, but we're not open, or we not step back from our tariffs we plan to bring up here for US products, for example. And this is in fact something which is showing that the words or the speech in general from Xi Jinping here wasn't necessarily 100% positive. However, the market consolidated at an elevated level and then took a hit here yesterday, lost some of these gains here, and then started again. But this is something you can see here. The market overall, in this case, we are talking about the German index. So let's use the German index here as a good indication for the European equity market, and that's usually probably something which makes definitely sense. So the trade war fears, that's something I want to mention. Trade war fears here. This is something which is obviously still a problem, still a topic. And the reaction here we have seen Tuesday morning was a clear sign of that. Then, and that was probably the reason, the trigger for the bearish action yesterday and the losses from which the DAX and the European markets, which they couldn't make back anymore, and also the US equity markets were incapable of really pushing us significantly back above 12,300 points. That was due to a tweet from Donald Trump yesterday, and I just want to show you. 1 second, please. Where do we have it? Here, there we go. Let me just see. Okay, so this is the Twitter account from Donald Trump. I just want to show you the following. Where is it now? Here, Russia vows to shoot down any and all missiles fired at Syria. Get ready, Russia, because they will be coming, nice and new and smart. And you shouldn't be partners with a gas-killing animal who kills his people and enjoys it. So that's a clear message, not only towards Assad here in Syria, but also towards Russia, obviously. And he's making clear that there's obviously a strong difference between Russia and Moscow right now. And so fears are starting to build that... yeah, I'm not sure whether it makes really sense to say something like that. So that a third world war is around the corner, but nevertheless, you can definitely feel the tensions here. And I, for example, heard about some Russian-speaking people that in Russian television, for example, people are already referring to war. So I think it depends on which country you are living in. But let's put it that way. You can clearly feel tensions, and it's not only trade war fears which are building, but in general fears around war, which could somehow be around the corner when Russia and the US clash here somewhere in Syria. And so with this in mind, and all the sanctions now brought up, for example, from the US, which resulted then in some huge volatility in the Russian markets in general. So therefore, let's have a look here. Euro Russian ruble, for example, here that was a sharp spike on the upside on Monday already starting, and then we saw a push to 80 around. That was Euro Russian ruble. Interesting enough, from a technical perspective, some technical traders will just say, well, really, was this the trigger? Whatever the trigger was, finally this ascending triangle was broken. For whatever reason, somehow it doesn't work the way it should. Okay, so unfortunately, it seems as if it doesn't work. Usually you can cut this off here. So usually you can make sure that this line is not prolongated here by taking off this or unchecking this box, but unfortunately it doesn't work for whatever reason. But I think it becomes clear what I'm talking about. So Euro Russian ruble, very exotic currency pair, nevertheless worth looking, because I also have some thoughts on this here too. And then let's come back to the equity markets. But first of all, Euro Russian ruble. And also WTI. But first of all here, so you have this ascending triangle, and I think that does make sense to now bring this up here, because some people might say it's very difficult to see a real pure technical reaction here based on the current tensions building and the sanctions against the Russians. And so just bringing this down to technicals is probably not getting the job done. But I like to introduce a concept to you here, which shows you, or in the future probably, you have a better chance to make sense out of charting patterns. And today, let's start with this, for example, here with this formation, which is forming here a so-called ascending triangle. The same is true for descending triangles, but this one is the ascending one. And what you can see is the market has seen several attempts to break this region here around 72 and failed to do so. But the interesting thing is now that, and that's why I've here also drawn this line, this rising trend line. You can see that the supply coming in from above 72 did not result in further pressure, but diminished earlier and earlier. And that was a sign that obviously the supply in general is diminishing, which makes it likely that the market will rather sooner or later break out of this formation here on the upside. The same is, by the way, true for descending triangles. And so if you see falling action, the market is finding some support, seeing a bounce, and you see another attack of the lows, you see another bounce, which is not making it above the former high, and then probably a third one, which is not making it above the second, but not even close above the first one, and that way showing that there's diminishing demand against this level, and that this formation would probably see some further action once we break below the former lows then in this case. But this is only around this charting pattern. What I like to show you is the following now, but this is only a thought. That's the thought I just presented to the audience in the morning meeting. In this case, in fact, in the German version of the morning meeting. But let me give you this thought here too. Probably you can make sense of it for yourself, where you say, hey, this is useful, or you say, well, I don't trade such exotic currency pairs as Euro Russian ruble, for example. But all in all, I think it's probably worth it at least give it a try. So what I think is very interesting, we know that between the Russian ruble and, for example, WTI, so crude oil, there is a huge positive correlation. That means, in fact, if Euro Russian ruble goes down, you usually expect WTI to rise, crude oil prices to rise. Now, we haven't looked at WTI so far, but now first of all, let's have a look here. This is Euro-Russian ruble, and Russian ruble obviously sells off, which means Euro-Russian ruble spikes higher. And on the other hand, yesterday, WTI, you saw spiking to new yearly highs here, which is in fact a very, very interesting thing, because now I was thinking about the following. What about the so-called arbitrage trade? Which means I was thinking about trading two positively correlated assets, and therefore probably it's better to write this down. That probably makes a little more sense then. So again, RUP and WTI are positively correlated. That said, it means if WTI rises, so should RUP. Now the thing is that obviously WTI rose, probably because of the fears around military escalation in Syria, but Russian ruble didn't. And now the interesting thing is that I was thinking about a so-called hedge trade, where I think currently it seems as if Euro-Russian ruble and WTI are disconnected, but this divergence that it needs to rather sooner or later come together again. And that said, I think it's probably an interesting idea to say, then I'm selling Euro-Russian ruble and I'm going long WTI. I'm sorry, and I'm going short WTI, not long, because in this case you have a so-called over leverage position, because once again we said your ruble and WTI are both positively correlated to each other. So what my idea is now, go one of these pairs long. In this case, Euro short means you're going long Russian ruble, why you're shorting WTI, because the bet is that those two will connect again, so go together again. So this is the idea. It's a similar approach. In fact, you can also call this pair trading. The only problem by saying that is now the following, that with such pair trading setups, you usually can't work with a stop loss. And in fact, it's not sad that it's not only a gut feeling in mind, or it's a cognitive bias, let's say. To me, it makes perfect sense, but it definitely needs some further discussions. And I just want to give you this thought here and what you think about it, if it does make sense to you or not. If some of you probably listening to this right now have experiences here with trading such pair trading approaches here. Just saying. So that's it on WTI and Russian ruble. Now let's come back here to the equity markets. So as you can see now, the market, and this is what I initially wanted to say, and I really want to be honest with you. I'm not surprised to see this price action right now, because the thing is that after the comments here from Xi Jinping on Tuesday morning, and also after now, and especially probably, these potential signs that there could be a military escalation is something, when the market does not sell off sharply, then I think it's fair to say that's sign of at least some strength in the market here. I'm not saying that this is really strength, because the thing is that this situation again could escalate very quickly, and then you definitely don't want to be long in the market, because then I think the market can sell off sharply. In this case, the DAX has a very solid and fair chance to push aggressively towards 12,130 to 12,160 points here. So this is this green box on the downside. Nevertheless, I think it was at least not surprising now to see this push higher, because I think the main driver for this push higher was in fact another tweet which was done by Trump, which is showing some signs of de-escalation. What did Trump tweet in the morning? That was that here. I never said when an attack on Syria would take place. Could be very soon or not so soon at all. In any event, the United States under my administration has done a great job of ridding the region of ISIS. Where's our thank you, America? So, okay, let's just skip the last part, but let's look at the first thing here. I think this is really interesting because it's already a sign of de-escalation. So it seems as if he presents himself in a very aggressive way. The first step that was yesterday, and now he's stepping back from his rhetoric yesterday. And this said, as you can see here, 12:15. That was when so this is German time, by the way, and this is also German time here. So what you can clearly see is there is the bullish push. So the market sees some de-escalation signs here from Trump. And this is the reason for this current run. So now probably you wonder, why do I make this a topic? Because it's very important for us to identify a current advantage here, even though we don't necessarily need to do this, because we know that our trading approach we plan to trade here is a proven profitable one. So I will show to you a chart in a few minutes here, which will underline this again and show you that this approach is in fact a very profitable one, even though it doesn't seem to be profitable, and you probably can't imagine that. By the way, you definitely need some further input here. For example, on where to take profits. So in fact, how you define your loss or risk here is already given. You retrade the break of the open range in direction of the identified advantage, and then with a stop above, respectively below the high low of the range. Nevertheless, it's not saying where to take profits. And in fact, the thing is that we're not taking profits intraday at all, we take them intraday if there are any profits. But if the trade is not stopped out, then we take out the trade automatically at the same time every day, which is currently 7:50 p.m. GMT. So that's the day at the time when we just take out the trade. And what result you get there is something I just want to show you a little later on. But what I want to do right now is here with this first overview of where we stand currently in the market, I want to give an idea of what's my current take on the US equity markets and where I see the advantage, my personal advantage. So I already give the strategies a discretionary touch. The reason I do that is because I try to optimize the positive value, positive expected value of a basic strategy, and try to increase this expected value over time then. And so what you can currently see is that all in all, we're about to open slightly below the highs from yesterday here. And in fact, let's see whether the US equity markets, when the spot market opens. So in fact, this is no OTC trading taking place here, but it is real trading because the E-mini S&P future can be traded around the clock. As not really, because there's a 15-minute trading halt or interruption here shortly after the market closes then at 8 p.m. every day right now. So it's 15 minutes from 8:15 till 8:30, and then trading starts again. But all in all, the market is traded around the clock then here. And so when looking at this region, you can see that this is a very, very significant region. Because if we take out this level here around 2,660 to 665, 670, probably we can also go a little higher, 680. That's a clear bullish sign, because now you can see that the market has, in this case, after showing some signs of consolidation here, would generate some bullish potential, which could easily push us higher than also into the last trading day of the week. So not only today, but also tomorrow. So that could be a very, very bullish sign. And that's, in fact, very interesting. What do I mean? Or why do I say this? Well, we need not right now know that the current bias in the markets, or in the European equity markets, is obviously positive. If looking at the DAX, if looking how the market reacts here to the comments from Trump, who is probably willing to somehow de-escalate the situation in the markets. And then on top of that, from a technical perspective, you can see that this is a quite significant region we are about to at least attack here. And so with this said, obviously, I think it's not the worst idea to consider when a long trade is triggered based on our setup here, that we probably trade the long side a little more aggressive than we trade the short side. So, let's put this in numbers here and give an example. So let's assume you're usually risking 1% per trade. So when trading the short side, I probably cut this in half and only trade a risk of 0.5%. While when trading the long side here and seeing the advantage on the long side and probably strong technical breakout ahead of us, I probably go for a risk which is slightly higher than 1%. So let's say 1.2 to 1.3% probably, and trade this in a more aggressive way. And this is the first step, in fact, to try to increase the overall positive expected value of my trading approach then. By the way, I just see a question here from Barry. What about on cable, respectively pound sterling, GBP, USD? Let's have a look at this a little later on. Okay, so but I definitely want to have a look at it. It's no problem. But currently, let's probably first focus here on the US equity markets, because if we now start to talk about pound sterling, I think things probably get a little mixed up here, a little too fast, and then probably people get lost in all those markets and all these thoughts. So first of all, let's have a look here at the S&P. So with all this said, well, I think then we are well prepared, let's say, for the trading to come here, and let's just wait and see how the market opening will take place. By the way, let me just give you an introduction here to all these lines, especially the horizontal ones and the vertical ones. So the vertical ones are those from 1:30 p.m. GMT till 8 p.m. GMT, which is showing the main trading hours. So as I already stated, the market is traded 24/5 nearly, because here you can see there is this gap between 15 and 30 here, 8:15 to 8:30, and I'm highlighting this region mainly due to the fact that I can easily spot where the main volume is traded here. In fact, so I could also see this by having a volume displayed below the chart, sure, but we are talking about, in this case, we're talking about CFD product, which is mainly out of over-the-counter traded asset, which means that we do not have a clear idea on the exact volume which was traded. And so this is how I help myself out here in this case. The green line is the low from yesterday. This is this candle. The blue line is the closing price, which can be seen here. That's the last price yesterday, shortly before, or not shortly before, but the time when we just closed the trading day. Here's the daily high. This is the red line. And the turquoise line was already here brought to the first tick at now 1:30 p.m. GMT. So this is just giving me an idea of, are we trading above or below the opening of the trading day. And this exponential moving average you can see here, this is our exponential moving average 10. Second, please. It's the exponential moving average 10. To just see the advantage here in 2. And well, in fact, now the thing is, we're done. We are done. What do I mean by that? Well, it's very simple. We have to wait now. So it's no time to take action here in any way, but it's we just have to wait and see how the market now presents itself in the first 45 minutes of trading here, which is 1:30 to 2:15 p.m. GMT. And during this time, we can then think about how to define the open range. And based on the open range, how to then bring up a trade. That's in fact it. Just 1 second, by the way. I just have to look something up here very quickly. Okay. And now I have to, 1 second. I just want to make sure I have to build something up here in the MetaTrader. I've already prepared something, which I want to show to you. A very great tool. It's called the Traders Trading Terminal, the Mini Terminal, in fact, which can be used especially for let's call it day trading purposes. So short-term traders can usually profit from this in their trading, but I have to prepare something. I have to prepare something here. Before I present to you these thoughts. Okay. Okay, cool. So now, whoop, there we go. So one thing first. So some of you might be surprised right now because it's not the first time that I'm holding such a webinar here for JFD brokers on FX Street. But and so some of you probably have listened here to. Some of you have listened here to me several times, and now they are surprised to see that I'm showing a demo account here. That has to do with the fact that I want to present to you this mini terminal. And I don't want to do some trading tests, let's say, or test it here and give some examples based on a real account I'm trading. So that's why I opened the demo account here. So only if you're wondering why we do this exactly. And so now let's have an idea on this mini terminal and why it's such a great tool in your trading. So in fact, when you're using the MetaTrader, you can here open a new window or an order window in this case. And what you can see, by the way, probably makes sense to use the S&P then here. So what you can then see is that you obviously have different order types. In fact, two. You have market orders and you have pending orders. And if you have a pending order, then you can choose between buy limit, sell limit, buy stop, and sell stop. But that's it. So nothing more than that. And in fact, it doesn't look very nice at all, let's say. And on top of that, it's also quite difficult to manage the trade once you entered it. And this is something which this tool here, the mini terminal, can give you a huge advantage to compare to other traders. But first of all, that's probably the best thing to do right now. You might right now wonder, okay, where do I get this? This is something you can get from the website from JFD Brokers, where you have to have a demo account. So this is connected to a demo account from JFD Brokers or a live account. Depends on whether you're trading live or a demo. That doesn't matter, but you have to be minimum a demo client. And then you can go here via trading to platforms. And there you have the MT4 Plus in our case, or if you're using MT5, doesn't matter. So it's available for both. If you click on this, you have here the MetaTrader desktop and add-ons, and this is where you click on. And this is where you then can download those exclusive tools here for the MT4 and MT5, in fact. So it's the same page for MT4 and MT5. In fact, it doesn't matter if you click on MT4 or MT5. And not only that you can download it here, and then include it in the expert section, but also here you can see a mini terminal, some descriptions of this. That's what I'm talking about. So it's the manual you can download here, and it's not only the mini terminal, even though I think the most valuable tool here is in fact the mini terminal, but you can also, for example, have tools like the Excel RTD here, or stealth orders, or ticker trader, or sentiment trader, or correlation trader, respectively, a correlation matrix, for example, session map, and all this. And all this is completely for free for those who are downloading this this tool here. And after you downloaded it and included it here in the expert section, you can then open the mini terminal here in the MetaTrader, and there you can see that obviously many things become already tradable or accessible in a very great way. You can easily now, for example, enter the lot size here and then click on buy or sell, and you're in the trade. Then you can also, for example, here place a stop level in points. By the way, let me just have a look here. So look here. Okay. Okay, cool. So you can for example, let's say we are buying one micro lot now with a stop of 20 points and the take profit. I think that would make sense. Let's work with 5 here. So 5 to 7 or something like that. And then you just click here, boom, and you're in. Like this is the mini terminal and perfectly illustrating how fast you could enter the market. And not only that, but and this is the great thing about this, you can now, for example, probably I shouldn't show you how to move the stop loss because this is something you should definitely avoid. But you can easily, for example, move the take profit level here in a very fast and easy way. And I think this alone, for all these traders out there who are used to trade with the standard but quite old MetaTrader 4, but also quite old. Nah, it's not old, but you know what I'm talking about. So it's kind of it's not that handy. So it's not that nice. The mini terminal in this case here for active traders can solve this problem in a very nice way, let's say. So you can enter the market very quickly. You can predefine the stop levels, the take profit levels. You can then also trade or move the take profit level in this case here. You can also enter the market very quickly, let's say, have a predefined stop level, and then say, okay, I have to put the stop here. The only problem with that is be aware of the fact that you have to look at while trailing the stop to this level then does not go hand in hand here with a too high risk or respectively an increase in the risk of your trading when moving the stop then. And in fact, this is not what I want to show to you. So now the thing is, you can click here on order, close it that way. And what I want to show you, in fact, is something different, because I not only showed to you it was no coincidence that I showed to you the order types here. You have another great way to trade breakouts out of such ranges here based on the so-called OCO breakout order. And this is something you usually do not have here in the MetaTrader. And that way you can then place an order above and below a certain level and say once one side is filled, the other side is automatically canceled. Especially when, for example, working with such a, let's call it fast moving moving average here. I mean, we are only talking about the exponential moving average 10. It could be that the market breaks out on or is trading within a range and then decides to move sharply, dynamically in one or the other direction. And in that moment, also trading above or below this, in this case, purple line, so the exponential moving average. So that means the moment we are then breaking out on the downside, this is usually when a short trade is filled. And this is the moment when probably, let's use the example from yesterday here. So if you plan to go long because it looked like as if the market is breaking out in the upside, but instead it's then sharply reversing and attacking and breaking on the downside, this is usually then the moment when you want to reverse the order. And to avoid surprises here, working with such OCO orders can make good sense, let's say. And Yeah, so in fact, you can already see here, I'm making things a little easier in the MetaTrader itself. You can work with something we call a breakout indicator. The breakout indicator shows you the thin red and two thin red lines, which are highlighting, in this case here, the open range between 1:30 and 2:15 p.m. GMT. So currently, the S&P is about to work out these thin lines. So as you can see here, we have no thin line so far, but this has to do with the fact that we not even closed the first 15-minute candle here. But once done, you can see that this is the picture, how it looks like. And now you wonder, okay, and if I want to trade the breakout of this open range, how does it look like then here with this mini terminal probably? Well, you're looking here, we are trading above this purple line. Let's use the example from yesterday here. So we have here this level, which is 2,653. And now what I have to do, by the way, is I have to work with a buy limit here, because we are now, I want to show you here. I want to show you the current, I want to show you the breakout of this range with the orders and everything here from yesterday. Problem is that currently we're trading above that level. So if I'm now working with the so-called buy stop order here at this level, I'm getting filled immediately at the current price. So that's why I have to choose buy limit here, even though usually you're trading slightly below or slightly above the order level for the open range once you're trading within this. So you're not working with a buy limit, but you're working with a buy stop, respectively sell stop. And now we work with a buy limit because we have to make sure that we're not getting filled on this trade here. So then we have the low of this range, which is 2,638.7. Oh, by the way, that's something we should enter here first then. 653. A fixed lot size is also something very interesting. You can work with the fixed lot size, but you can also say that you're probably using X% of your ballast, something like 1%. And then you have a fixed price. This is the low of the range, which is here 2,638.5. 638.5. And we do not have a take profit level. So that's very important. We take out the trade at, again, if it's not stopped out, we take out the trade at 7:50 p.m. GMT. So I always have to recalculate this because I know the time exactly in German time, but not necessarily in GMT, but it's 2 hours difference. And then we place the order, and that's it. So as you can see here in this case, this is exactly how the setup looked like yesterday. So what happened? It was that here the market broke out. That was when the order was triggered. And then the market started, unfortunately, to trade sideways. It was very close here. We are not stopped out. And we took out the trade, I think here, somewhere here. It was a loss, yes, but it was not a big loss. It was not necessarily 1% in this case. By the way, something I want to show you a little later on. But we took out the trade somewhere here in this region. This is where we took out the trade. And yeah, so what you can also see here is, now you might wonder, 99.3, where's the volume coming from? This is very simple. We said risking 1% of our equity, of our account balance, I'm sorry, which is currently 117,000. And so that means we're risking 1% of that, or 1,170 euros. And now what it does is that it calculates those 1,170. It looks at the difference between the entry price and the stop level, and then calculates the trade size, the volume you plan to trade. And this is something which is done automatically. So it's something you don't need to take care about anymore. Also, one very good reason to probably use this mini terminal then. Yeah, so now you can see that the S&P obviously is showing some clear bullish signs. We are about to attack this level. By the way, and we can now delete this order here because it was only for illustration purposes. So what we have to wait for now, again, is another 30 minutes of trading until the yeah, until this open range as shown here is defined. By the way, just let me have a look here. Okay, perfect. Again, it's a very good start into the trading day. Again, here, have a look. That's a crucial level to watch. If we break above that, again, this is very, very bullish. It's a very bullish sign, I think, if we can make it above 67 to 60.80, even though that looks quite wide range. But again, in this case today, for example, I'd trade the S&P in a more aggressive way, mainly due to the fact that I think if we can make it above that level, there's further room given on the upside. And that's one of the reasons why I probably slightly increase my risk on the upside, while so far it doesn't look like that, but while I definitely be a little careful to trade the short side if we really break out on the short side and on the downside of this range. By the way, let me just have a look here at the DAX, what the DAX is doing. Okay, currently, this is, by the way, very interesting to see. So the DAX has some trouble here on the upside, which is showing that probably it's already exhausted. So the move seems to be, so far at least, seems to be at the end, which could mean if now the S&P corrects, that the DAX probably sees a sharper decline, which is not necessarily now the reason to say, oh, great, then I'm going DAX short, because I'd say from an intraday perspective, as long as we trade above the 50 exponential moving average on a 5-minute time frame, I wouldn't short the DAX anymore. That's a very good trend filter and something to probably take into account here. That's probably also a very good idea in your trading in general. So I'm mainly trading the DAX, so I know that the 50 exponential moving average here on a 5-minute time frame, which I also use as a trend filter when trading the open range, works quite well for me, or for my asset, in this case, the DAX here. And when I try to optimize the exit of my traded strategy, even though it's not necessarily said that's the same for, let's say, Euro USD or GBP USD or something like that. But it's definitely worth to look for such filters and trend indicators, because they can avoid, in your case, to take action when you probably say, oh, this is a good trading idea. Like, now let's short the market. I think it's better to wait until you have a clear confirmation that there is a clear and clean trend shift, in this case on intraday time frame here, instead of now jumping in and say, but I have a very attractive risk reward, and that's why I want to be short right here. I think that was also the case when you probably considered short engagement here, while the market shot higher. And it's not necessarily sad right now with US markets opening that we're probably about to see another sharper rise in the DAX on the upside. Then it's something which underlines why it could make sense to use such a trend filter, or in this case, an exponential moving average as the filter here, to look, or where the advantage can be found on the trading day. Now I want to do the following, because I promised it to Barry to have a look here at GBP USD. But nevertheless, I'm not yet done with the strategy. It's something I want to show to you a little later on the performance of the strategy. So first of all, let's have a look here at GBP USD, and then have a look at the performance. So I have to say that I'm all in all quite positive for GBP USD, even though I also have to say that currently I don't like the current volatility in the currency markets, which is one of the reasons why I'm not such a huge fan of the setup I will just present to you now, or respectively the ideas I want to present to you right now. And if I trade it, then I trade it definitely with a reduced position size. So currently it seems as if GBP USD is about to at least attack the region around 42.50, 42.70. The only potential driver for potential bigger volatility, respectively, from a fundamental perspective, I think the only potential driver could be found yesterday with the industrial production. With the industrial production here. Let me just have a look 1 second. Yes, so numbers were published yesterday. They came in slightly below expectation, but, and this is the thing, pound was capable of withstanding some selling pressure here from this side. And also with, yeah, I think when looking at the US dollar yesterday at 6 p.m. GMT, when the Fed minutes were released, the interpretation of the Fed minutes could be somehow hawkish. And so with this in mind, I have to say that the performance right now from pound sterling looks quite good, very great, very good, strong. And that's one of the reasons why I'm quite positive here for a potential break on the upside of 42.50, 42.70. And if we make it above that level, I think further targets can easily be found around 43.50. This is the current region of the yearly highs here. And we are positive on a 4-hour time frame, in fact, as long as you trade above 39.70 to 40. Yeah, so my overall outlook right now for cable is definitely positive. And I think we are about to see, probably at least into the weekly close, an attack of the region of 42.50, 42.70. And if we break above that, I think further room is given up to the yearly highs, which could bring us as high as 43.50 and probably even higher than that. Yes, so that was these were my thoughts on pound sterling. Now let's come back again here to the S&P, and here on the performance, respectively, not necessarily on the S&P itself, but let's have a look again at these parameters for the setup, and then let's have a look here at a chart. 1 second, I just have to see where I have it. Here it is. The performance. Okay, 1 sec. No, that's not. Is this the chart? No, the other one. Here. And I want to show you here this chart. So what does it show? It shows the results of a backtest of this approach I presented to you on the slide before with those input parameters. Here you can also see the exponential moving average 10. It shows the parameters back to November 2010 here. And it perfectly illustrates that we had a number of 1,347 trades here. And during this time span, we saw a hit rate of 47% and an average profit and average loss. If you calculate the ratio on these two, we call a payoff ratio. You have it of 1.3 to 1. And with a hit rate of 47%, this is resulting in a so-called positive expected value. So the interesting thing is, if you ask someone if he thinks he's profitable in his trading or not, he might say yes or no, but few really know what profitability in trading really means. And profitability in trading is in fact defined, losing rate multiplied with loss rate is defined as trading with a positive expected value. That's what it all comes down to. And so now when you put in those parameters here, I mean, this is a backtest result. So nevertheless, we all know the saying, the trend is your friend, which means if it has been a profitable approach for the last 7.5 years, we can expect it to be profitable in the future too. And in fact, this is a result which can also be extended to an even a longer time frame. In this case, the backtest wasn't run longer, or we have not tested it for a longer time span, and this has to do with the fact that we didn't have enough data available. But I think 7.5 years is already quite good here. And if you put in these numbers, let's shorten expected value up to the V then, and we multiply 1.31 with 0.47. So this is the hit rate. And then we subtract 1 multiplied with 0.3. We get, and don't call me a nerd now, I know this number because I've calculated it several times. So it's 0.08, which is bigger zero. That means that on average, per euro we risk, or US dollar, or Japanese yen, or pound, whatever, we make on average 8 cents. But please don't get this number wrong. So there were plenty of people then saying, I'm sorry, but does it mean you're risking €1 to only gain 8 cents? No. This is something, again, the average winning trade here can be found in this column, and the average losing trade can be found here. What I'm referring to is it doesn't matter if you're winning or losing, but you can expect to win on average per trade you make. It's a winner or a loser, you don't know, because it's nearly a coin flip. It's 47% hit rate here, but you can expect to make 8 cents per euro risk per trade. And that means, for example, that if you're risking 1,000 euros and you multiply this with 8 cents, then on average you're making 80 euros per trade. You trade this setup. And now the law of the big number, let's say, comes into play. The more trades you do, and the more often you try to capitalize on this identified advantage, the more money you're expected to make. Then, the more money you're expected to make. This is not true, but the more likely you'll see a positive outcome of this, because you're trading with an expected value, which is positive, meaning you're trading a profitable approach. And this is what profitability in trading, in fact, is about. And now, and this is unfortunately something